year-on-year and 63% year-on-year growth in Q2. However, we are not suggesting that is likely to be the trend for the full year, because as you are all aware, the Q1 of financial year 21 was affected by COVID. However, it is a very strong growth momentum that we're experiencing in the beauty business. We'll move on to another important element of the beauty business, which is on page 10, which is the AOV. And I particularly point this out because many of you asked us this question in our presentation. All of you said that in Q1 and Q2 during COVID impacted times, our AOV went up from 1,450 pre-COVID to almost 2,100 to 2,168 levels. And many people asked us the question whether it will sustain. So, of course, we had very strict shipping policy during the COVID times because of constraints on supply chain. However, even post that, when now there are no constraints and we've eased our shipping policy both on COD and on minimum shipping levels. But even in spite of that, our AOVs have maintained at the level of 1,913. In fact, it's up over last 3 quarters, from 1,763 to 1,913. So we are happy about being able to maintain our AOV. As you know, the right unit economic metrics emerges from good AOVs. On the annual unique transacting customers, also I want to point out, which is on page 11, we have now reached 7.2 million. And I think many of you were disappointed about the number of 5.6 million versus 5.3 million just a year ahead. We do feel that some of it, there was a COVID impact. We did grow at 35% in spite of the COVID, but at the margin, COVID did take away some amount of our growth. And as we come out of COVID, we do believe that we are experiencing stronger growth. And that is evident in our annual unique transacting customers, which grew quickly. We are also spending more on marketing to achieve that. As you move to the fashion business, and I'll take you to page number 14, I just want to point out that as you are all aware that fashion is in a sequential growth phase, and we have seen a huge number of increase in annual unique transacting customers, which in the Q2 stands at 1.3 million against just 0.2 million a year ago. So that's a massive growth in transacting consumer on our fashion platform. And the GMV growth also continues to be strong, with an extremely strong growth experience between Q4 of financial year 21 and Q1 of financial 22. You saw our GMV go up from 268.6 crores, this is on page 14, to 384.8 crores over just one quarter. And even on such a strong quarter, we are now seeing 14% sequential growth. We move on to the next part of the presentation, which is the financial highlights. Sorry, just before that, I'll also point out that on the fashion side too, our average order value has been strong, and it is at 3,257 for this quarter. Now I'll come to the consolidated financial highlights. So revenue from operations grew at 47% year-on-year and 8% on sequential basis. Marketing income in beauty business continued to be strong and came out at 68% year-on-year. And income from marketplace services, which is entirely driven by fashion, grew by 326% year-on-year. This led to gross profit of 378 crores, which was a 59% growth year-on-year. And the gross profit margin, and all of this is on page 17, gross profit margin came out at 42.7% against 40.6% in the previous quarter. It was an improvement of 213 basis points, primarily led by increase in share of GMV from own brands, as well as increase in share of fashion GMV. Ebitda has come out at 28.8 crores, 288 million rupees, with a flat EBITDA margin of 3.3% compared to the first quarter. Marketing and advertising expense as percentage of revenue from operation is at 13.7%, higher as compared to 11.1% in quarter one of 22. So marketing costs have gone up from 11.1% in the first quarter to 13.7%. And this is hugely higher than what we had experienced in the first half of last year, causing a little bit of concern amongst market participants who don't probably understand that we are in a very conscious manner increasing our marketing spends because they were artificially depressed in the first half of last year due to COVID impact as well as fear of COVID and the period up to which COVID can last and impact our business. So with that fear, we had spent very limited on the marketing costs. In fact, in later tables, you can see that our first half marketing cost last year was just around 4.2%. And even the second quarter marketing cost was only 5.6% of net revenue. That has changed where we do believe that going forward, we will spend somewhere around, higher levels, definitely higher levels, and somewhere around this or slightly lower levels in marketing. But all of that will be value accretive is our promise. On the profit side, that has resulted in 1.2 crores or 12 million of profit in quarter two. And that is, profit after tax. And that compares with 4.7 crores, which was achieved a year ago. However, if we look at the half-year comparison, our profit, we had suffered a loss of 25.1 crores in the year ended first half of financial year 21. 251 million, if I may say so, was the rupees 251 million was the loss during the first half of financial year 21. And that has now come out at 47 million profit for the first half of this year. So I think this is on page 17, if I can clarify. So in our mind, if we look at it from a strategic perspective, we are balancing between growth and profitability. And our intention is to deliver strong growth because we think these are very fortunate times for e-commerce companies to try and tap into consumers who is more accepting of e-commerce. And of course, being disciplined about trying to maintain a unit economics that makes sense, not just for beauty business, but also for fashion business. However, fashion business is at an early stage of growth. And as a result, if we were to look at the EBITDA of two businesses separately, which is something which we have not shared, but the two businesses, if we were to look at it separately, clearly fashion business is at a stage where we are continuing to spend more than our revenue, in the sense that even if we cover all direct costs of marketing and fulfillment, I don't think we are covering our overheads on fashion business. But we believe that as we continue to grow this business, we will be able to show similar discipline on unit cost economics the way we are displayed for beauty. With that, I'll go on to the next page, which is page number 19, where I think some of these costs that I talked about, there is a graph called gross profit margin and key operating expenses, where you can see the quarterly trend. You can see the first three financial year trend, financial year 19, financial year 20 and 21, followed by quarter one and quarter two. And you can clearly see that the gross margin has gone up. Both fulfillment and employee benefit costs are under control from a long-term trend perspective. However, marketing costs are slightly edged up. And but against that, there is enough to show in terms of be it visits, be it unique visitors, or be it transacting customers or orders in GMV. With that, I'll highlight a couple of other business developments. And of course, there are items of P&L and balance sheet that I can take, but I thought I could take it as part of I'll take it as part of the question answer rather than right at the beginning. So with that, I'll talk about the 5 important business developments. One being that all of you must be aware of the Dot & Key acquisition that we did. We believe it's a fantastic company. And this is part of our presentation on page page 6, where we acquired Dot & Key, 51% stake. It's a brand which is in skincare, personal care, and nutraceutical. And we do believe it's a fantastic brand with a lot of promise going ahead. The amount of money that was paid for acquisition is all known in the prospectus, so I won't repeat it. The second important initiative has been the Superstore by Nykaa, which is our Ebitda business, which we launched during the Q2, and it is having good initial success. And it plans to Superstore by Nykaa aims to support and empower retailers across India with a view to offer them the best of beauty and personal care products, which they can then onward sell to their customers. In fashion, we also launched a label, Gajra Gang, which is our ethnic wear label. It is meant for a woman who refuses to be labeled, and it offers ready-to-wear collection of modern occasion wear and balancing between focus on craftsmanship, tradition, and wearability. It is focused on empowering women's choices, and as a result, it's a brand totally on point with what Nykaa customer wants. We continue to grow our store expansion with a rollout of 8 physical stores in this quarter, and they are reaching cities like Gwalior, Cochin, Mysore, and Ranchi. And with this, our total operational stores has gone up to 84. Nykaa also continues to ensure that across there is access and timely delivery for all customers across length and breadth of the India. And for that, the warehouse storage capacity has been growing with 0.37 lakh square feet of capacity added during Q2, which has resulted in our total, warehouse capacity going up to 6.65 lakh square feet. With that, I think I can take a break and open it up to questions. And there are certain aspects of the balance sheet and P&L which I have not addressed in this presentation, but I can take it as part of the question answer.
Thank you very much.
Is that okay? Should we open to question answers?
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Percy Panthaki from IIFL. Please go ahead.
Hi, ma'am. My first question is on the market size for BPC, which in the prospectus you've mentioned around 1.2, 1.3 lakh crore. However, a very large part of this market is actually mass market brands like, let's say, Lux or a Lifebuoy soap or a Colgate toothpaste, etc. So if you are going into these kind of products maybe sometime in the future, I mean, I'm sure you have all this on your website, but what I'm trying to say is if there's a material contribution coming from such products in the future, how does that affect your gross margins? Because the trade channel margins on these products would be much lower than the margins that you're getting on your current portfolio.
I think I'll just come in and say that as far as our prospectus was concerned, we have declared that 70% of our business is from the 3 categories, which is makeup, skincare, and hair care. Hair care within that is also included there, but besides that, at least 30% of our business is in other categories, which of course includes appliances, it includes fragrances, and it also includes personal care. So personal care, which actually includes some amount of hair care and skin care, is already a reasonably decent sized business in our firm. And we don't look at margins only from the perspective of the margin you receive as a retailer. First of all, because we play a role of a retailer and a distributor, and we buy directly from the brand partners. And also many of the brands also see us as a place where they can actually build customer awareness and access for their brands and acceptance of their brands. So for that, they also share with us, they buy our various marketing assets, and they share with us additional margins through this, margins in the sense additional money through this marketing role, where we play a role as a marketeer for them. So with that, we don't think there is any adversity across segments. Yes, within that, there could be absolutely some categories like toothpaste, which may not be the best place to buy those on our site. But I think there is a fair amount of business in personal care that we do, and that includes hair care, personal care, bath and body, and a number of other products which are like personal or like beard care or shaving or or personal feminine hygiene. So there's a whole lot of categories. We see big potential in our platform to reach the customers. And in general, we believe that there's a trend towards premiumization in all categories.
Right.
But I don't mean that we don't sell non-premium. Like, say, if I take example of sanitary napkins, we sell enough of the base sanitary napkin like Whisper and others, but we also sell, all cotton sanitary napkins, and the share of many of those is growing, and those are definitely premium products. Same thing with body washes. We sell all the basic body washes from ITC or Nivea and others, but we also equally sell premium body washes from Bath and Body Works and The Body Shop and Nykaa's own brand Wanderlust and others.
Understood. Secondly, I just wanted to touch upon the margins and especially the marketing cost which has gone up. If you can give some flavor as to what part of this increase is because the fashion business is in ramp-up mode, and what part of the increase is because the BPC itself needs a higher spend given that the base comparator is very low.
Yeah, so I think while we don't have a very good guidance on that for you right now, I think going forward we'll work towards giving that very specific guidance going forward. But you're absolutely right that when a business is at an initial phase of scale up, like fashion business has been, where it's growing very rapidly and you're acquiring a lot of customers to the platform, your mix of new customer versus repeat customer is such that the overall cost of marketing is high because we are bringing a lot of new customers to the platform. And that settles in at a more optimum level once you have a better mix of new versus repeat customers, for the platform. So fashion is now 2.5 to 3 year old platform. And as a result, we do see marketing costs coming down, but yes, they will be at a substantially higher level than beauty. So I won't say that marketing costs have gone. So let me put it this way, because I don't want to say anything that's untrue. But if you see the first half of last year, which is, for the September 21 ended first half, the marketing environment was very benign because things were, nobody believed, you could first 3 months you could only do essentials only business. And nobody was marketing much because everyone was scared and they were conserving capital because they had huge losses in first 3-4 months. So I think there was no major marketing competition, and as a result, our marketing costs in the first half of last year were unduly low because nobody was marketing. We also were conserving capital. We didn't do market enough. All that has changed now, and everybody's picking up on marketing. Having said that, so there was unusually low cost of customer acquisition during first half of last year. That is not there. But if you look at it overall, we are back to the long-term cost of customer acquisition, which also varies by category. So I think we do believe that things are coming back to the long-term cost of customer acquisition levels, both for beauty and of course fashion is a new business for us. So it's not like we have a long-term benchmark. But from our perspective, we do believe that we would like to do this business in such a way that we keep in mind the LTV, the long-term value of the customer versus the cost of customer acquisition. And that's why one needs to be measured in terms of the quality of customer one acquires and all the effort that goes in converting the customer through the funnel, so that overall cost of customer acquisition versus long-term value coming from that customer is a healthy mix.
Understood. If I might just push the envelope a little bit more on the margins. See, you had about 6.5% margins for FY21, both the segments put together at a consolidated level. How many years or quarters do you think before we will cross that benchmark for the consolidated company?
You're talking about the EBITDA margin?
Yes.
So, I think by now, I would like to share with most of the investors that for e-commerce companies, profitability and near-term profitability is the balance between customer acquisition, mix of customer acquisition versus, pace of new customer acquisition. And as a result, it's something that can be optimized for, because 85 to 90% of our marketing tends to be what we call is performance marketing, which is optimized to a certain efficiency vis-a-vis the sales. So of course, our marketing costs are higher, like I told you, in the new verticals when we are building them. But once those verticals settle down, then again the marketing cost comes down. So I think for us, I don't want to predict into the future, but it is something that we believe that nothing has changed in terms of how we will look at the balance between profitability and growth. And yes, last year comparisons are difficult because it was a different year, and I think from a perspective of I would urge investors to look at marketing costs in conjunction with the new customer acquisition and customer engagement in terms of monthly customer engagement, as well as trailing 12-month customer engagement and stuff like that.
Absolutely, ma'am. Thanks a lot, and all the best.
Thank you.
Thank you. The next question is from the line of Arnab Mitra from Credit Suisse. Please go ahead.
Yeah, hi. Thanks for taking my question. So my first question was, if you look at year on year, a lot of the BPC growth is driven by orders. In fact, more than the full growth is driven by orders, and your visits are also up quite a lot. But when we look sequentially, last couple of quarters, it seems with AOV driven, the orders growth is relatively low. Is this something that is of concern to you, and or should we broadly look at the GMV because the customer may be bunching up orders in different periods of time? And also, if you could just help us understand a bit on the seasonality in BPC, because you look at these e-commerce companies sequentially, but is there a significant seasonality that we should be aware of?
Yeah, absolutely. That's a very important question, and thank you for that. So yes, there is definitely seasonality in retail business, in lifestyle business, and October to December is seasonally the strongest quarter. And post that, and October to December quarter is very strong because of 3-4 reasons. So one being the fact that Diwali falls in that. Secondly, the marriage season starts then. And thirdly, of course, the year end, the entire festivity of the year end buying also comes in there. So I think with that, it's a very seasonally very strong quarter. Jan, Feb, March is not as disappointing as it was last year, because what happened was that for year ended March 20, the Jan, Feb, March quarter, suddenly the COVID came, and around third week of March, and first the stores started shutting down, and then a lot of e-commerce parcels were also not delivered. So I think you are not getting a good sense of seasonality there. But I do believe that the Jan, Feb, March quarter will never match up to October, November, December, which is quarter 3, but it can be a reasonable quarter. And then what we find is that the first half is definitely seasonally weak, and particularly also the second quarter, which is quite weak because of Shad period normally falling in that quarter, as well as quarter quite affected by monsoon through length and breadth of the country. So there is some amount of challenges in that quarter. Last year, again, the second quarter was a little different, and that's why year-on-year comparisons are suffering, because last year, second quarter saw some amount of revenge buying, because first quarter was entirely shut for non-essential category, So second quarter was strong. So I think this year it is very difficult to understand, but yes, believe me, there is seasonality. Second half is stronger, and it does take a fair amount of effort in the first and second quarter to continue to grow the customer base, so that you get the effect of that customer base that you brought into your net, through the customer's repeat behavior, because on an average our customers buy 4 times in a year. So instead of waiting for the fourth quarter only to sell to them, we keep acquiring customers throughout the year, and then potentially many of them come back and buy with a much strong gusto during the season. which is the second half. So it's a pattern we've seen, and as you observe us over the years, you'll find similar patterns.
Sure. Thanks for that. And my second question was on AOV. So what we've seen in some other industries, though they may be very different, like food delivery, is that as the customer growth happens, the AOV tends to fall very rapidly as you go down the income curve. In your case, at least last year, but there was still an explanation that it was COVID and people may have been bunching up and putting lesser orders. But would you expect the AOV to drop as you grow and you go down the pop strata or income strata, or is there some way in which it will be mitigated with some other levers?
Yeah, so our past experience has been that we've had a similar AOV across tier 1, tier 2 and 3 cities. So basically now already 60% of our business is from tier 2 and 3 cities in beauty. In fact, at consolidated level also similar. And it is definitely not showing any signs of being different from a AOV perspective. That is also because of the fact that we are basically giving access to less distributed premium products through our platform, which customers through length and breadth of the country are buying through us. And unlike, I don't know about other businesses, but Nykaa is a very pure B2C business, because from the very beginning, we do not allow retailer orders, and we actually cancel retailer orders. So in many ways, most of our business is a consumer-facing business, and as a result, we find that consumers are, because of the geographical way in which India grew, there are a lot of different industries in different part of the remote part of the country. So somewhere there'll be a tea industry, or there are plants in certain far-off areas from where the demand comes. So we don't find too much difference in the AOVs of the customers.
Okay, thanks, Falguni, so much, and all the best.
Thank you.
Thank you. The next question is from the line of Garima Mishra from Kotak Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. Couple of questions. One, can you please highlight the contribution of the offline channel in your overall revenues? And second, could you also comment a little bit on the fashion business AOV? For the last, let us say, 3 or 4 quarters, AOV has really scaled up. You would attribute that more to premiumization, or this would be more a function of customers buying more clothes per order?
Yeah, very interesting question, Garima. So I'll tell you a couple of things. So first, in terms of, I'll first address the fashion AOV. So fashion AOV looks like it went up from 600 all the way to 3,500, but I think it is because of the assortment kept growing. So initially we had a very limited assortment, mainly started with easier categories of accessories and stuff like that. And as the assortments have been growing, and again, a lot of brands find our platform where they can sell premium products, new launches and everything, which they tend to sell at full prices. So because of all of that, and as customers also getting more comfortable with our platform and developing trust in our platform, the value that they're buying is going up. So we are clearly seeing a increase in AOV, which is driven both by assortment and also by consumer trust. You are aware that in beauty, customers buy almost 5 items in a cart, whereas in fashion, when it began, it was only 1.3. That's also going up now a little bit to 1.6 items in a cart. So there's some amount of benefit of that. I think on the first question that you asked about BPC, beauty and personal care, if I got it right, I think it was about, sorry, can you just repeat what exactly you wanted to know there?
Yeah, I just wanted to know what is the contribution of offline business to your BPC revenues or overall revenues, whichever way you may want to tell us.
I'll tell you a couple of things, Garima. Right now, we don't want to disclose things that we haven't disclosed in the prospectus, but I totally understand that in the long run, we will share that. The reason why we did not share it was because of, COVID impacted on and off. It was like a very confusing number in the last couple of months or years, like last 1 or 2 years. But we do believe that, it will come back. I mean, already the retail business is back to its pre-COVID level, and we will now have a more sustained and regular increase in store growth, number of stores that we grow. So I think there will be better pattern to it, and I think in a couple of quarters we will make sure that we start sharing that number. But it remains small, and if I may say, I think during COVID times and during the prospectus time, it was sub 10%.
Understood. Thank you so much for those clarifications and wishes.
Right now, but right now there's a lot of strong momentum in physical retail. And like we always emphasize that our business is omni-channel. We treat all customers in the same bucket. So every store customer is added to our database and we start sending them, all our notification, mailers, everything, so that we start buying online. And similarly, also to online customers, we are always, depending if there's a new store opening in their vicinity, we are driving them to go to our store and experience, because we think that sometimes customers like to do that. So as a result, what we find is that in whichever city, we go, we actually see a strong momentum, in both the businesses, online and offline. So we believe it's truly an omni-channel business, and like you can now see, we are rolling out in more and more cities,
So just a factual clarification there, when you disclose GMV and transacting customers, does offline also form a part of it? Or is that, those metrics are completely separate?
Yeah, I think so. We would include everything.
Got it. Thank you so much for the clarifications.
But so we would include all of it. So it's a consolidated, all of beauty business, all of fashion business. In fashion, there are no stores right now, only one store. And in beauty, of course, we have now more stores, 86 or something.
Yeah, I'm just confirming, Garima, that retail sales GMV is also part of the beauty GMV and total GMV.
It is.
Yeah, it is part of it. Yeah.
Thank you. The next question is from the line of Ebitda from Macquarie. Please go ahead.
Hi, Falguni and team. Thanks for this opportunity. You have clarified that AOVs don't vary a lot between cities. Is the understanding, or is there a divergence between the company average and an old customer or a customer with a longer lineage with us?
Yeah, if I understood your customer right, question right, our AOVs of the customer go up with every subsequent purchase that they make, right? Mm-hmm. So the first time the first AOV of the first purchase of the customer is always lower as in entirety. Of course, there are customers who will come and buy worth 15,000 also in the first order. But what I'm trying to say, in entirety, the AOV of the first purchase is lower than the AOV of the repeat purchase.
And typically, what multiple does it come to, any kind of numbers versus the company average for a longer, customer with a longer transaction history?
We haven't disclosed it. In future, we can. But, it also changes. Like, the AOV of all the customers who only bought 2 times, or AOV of a lot of customers who bought 20 times. It all varies. And of course, on an average, we say that most of our customers who are retained, we retain a lot of our customers, and the ones who are retained also buy about 4 times in a year, as evident from total number of orders to unique customers who buy. So I think with all and I'm talking here about beauty numbers. So with those kind of numbers, obviously there are customers who have been with us for 5-6 years now. So the number of orders are much higher. So and then by then the AOVs really look very strong, because by then customers have a lot of confidence to buy a lot more categories from us and a lot of even more valuable products from us.
No, fair enough. I was just trying to understand that, but clear. I'll kind of wait for that disclosure.
Yeah, we don't have a firm guide. We'll work towards it. I think after listening to your questions, if we see that everybody wants certain type of data, we'll work towards sharing those over time. It's not easy because it varies a lot across businesses and stuff like that. Because, what happens is that also customers start buying a lot more items in the cart,
Yeah, no, I mean, it's just that it gives us a sense on the value of a customer once it becomes, that is where I was coming from. But I get your point that it will vary a lot, but it'll give me a sense. That is where my question was directed to. But my second question was on the fashion side. I mean, I'm just trying to understand the broader positioning. Is this more towards a curated content that you want to kind of focus on versus discounting? And if yes, does not having inventory, which was a big differentiator, kind of act as a hurdle? That's all.
No, I think on the fashion side, if I understand the question right, we are focused on bringing curated assortment to our customers, which means that we are not an open platform where anyone can come and sell anything. We are actually doing some amount of pre-selection for on our customers' behalf, saying, is this good quality? Is this a sought-after brand? Is it the right on trend for us that we need to show it? Because even from our brand partners, we don't take their full catalog. We take their more what we call is on trend, new launches, the right popular catalog. We don't have commitment to offer and show everything from our brand partners on the fashion side. So I think it's a very curated catalog that we bring. And then within that, we also facilitate through, discovery, as we call it, but through discovery, we facilitate customer discovering a lot of new brands, new on-trend styles, and a lot of stuff like that, which allows for better consumer experience in terms of how they experience the website and how they are satisfied with the purchase. I don't know if Ebitda, you want to come in here?
Yeah, happy to come in. So yeah, I think there are three pillars on which the fashion business is being built. The first is as FN mentioned, highly curated merchandise. I think fashion platforms need to have a point of view. There's a lot of product out there, and one of the big pain points we heard from customers was that on other platforms you get lost, it's very cluttered. So that is why the philosophy of merchandising is, can we really curate and can we handpick the right products, the right brands, and really make the customer feel that, okay, this is a platform which has a point of view, and I know what they stand for, which is slightly more premium, very high on quality, very style driven, and very trendy. I think the second pillar in fashion is inspiration, and that's really what we did with beauty as well, that Indian women are looking to be inspired, how to dress, how to really uplift their outfits. So tons and tons of content is being created and intertwined with the shopping experience. And the third pillar of the fashion business, as you also insinuated, is that we're striving to build it as a marketplace, because I believe that inventory risks in fashion can be higher. So we would like to build it as a marketplace, and we built all the technology to support that. And we're scaling it well on a marketplace model, which means we're not holding inventory for the most part, for a large part of the brands.
No, Ajita, what I was trying to get to is, because we don't hold inventory while in BPC, that is the key difference that I see. And is that, while their positioning is the same, that is where my question was, that why do you think it would be different? But we can probably take it offline. That was where I was kind of trying to understand, why do you think fashion does not need inventory while BPC did? I understand that it has kind of worked in BPC, but in fashion, do you think that reduces our competitive strength to some extent?
No, I actually think that
I'll come in here, Adwaita, just one quickly,
Yeah.
and then you can add.
Yeah.
It's just that we realize that the number of SKUs that you need to offer in fashion is very wide. And even the brand partners very often, sometimes some brand partners are okay for you to pick up the inventory, and we may do that in future. But many of the brand partners also want to keep the inventory all in one place and sell from there. Because if they were to allow certain partners to pick up certain inventory, and then it will be divided into so many buckets from where it can't be all accessed. So fashion business is developed a little differently, and hence marketplace is the way to go. But yeah, there could be some brands that we do based on inventory led. Ebitda, you want to come in? Sorry.
Yeah, I think, there's one very big fundamental difference between fashion and beauty, and that is that beauty is a very brand-centric, and within brands, very hero product-centric business, which means that, the same product ends up selling well for decades, and that's the nature of the beauty category. Fashion, on the other hand, is so fragmented, where things go in and out of style so frequently, and every brand is launching thousands of new drops every quarter. So, given that sharp difference, that one is very brand, very product, hero product led, and one which is very trend, very frequent drops, very high on SKUs led, I think the choice between inventory and marketplace stems from that fundamental difference. Okay. Does that answer it a bit better?
Yeah, this is clear. Thanks a lot. Thank you very much.
Yeah.
Thank you. The next question is from the line of Jignesh Kamani from GMO and Company. Please go ahead.
Hi, Falguni team. Congratulations for the good set of numbers. If you take about our monthly average unique customer grew very healthy at 62% YOY and 11% QOQ. But it transition to GMV growth and annual unique transacting customer will be slightly tepid at 40% and 30%, 38% kind of. What explains slightly weak transition from the MAU to our GMV?
I'm not so sure if I've understood your question fully because it's difficult to hear very clearly. But I think if you're talking about the consolidated mix and you're saying that why is the GMV growth higher than the growth
So I'm saying
in
our
revenue?
MAU growth has been close to around 62% YOY, while GMV growth is around 38%. So I'm saying conversion from MAU to GMV is slightly weak this time compared to our past. So what
Net
explains
revenue. Yeah, you're talking about difference between net revenue and GMV growth,
no,
right?
no, from the MAU to GMV?
Yeah. So because our net revenue for beauty is booked based on net sales of the product.
Revenue. I'm talking
whereas,
about MAU, monthly average visitors.
Maybe I can take that
What is
continuously from it.
Yeah, go
This
ahead.
is Arvind.
Hear
Yeah.
the question clearly, yeah.
Sure. I could hear that. And I think the question is, while our monthly average unique visitors have grown by 62%, the visits and the growth in TTM is lower at 30% and 40% respectively.
Exactly.
And the answer to that, in my view, is that while we have stepped up our marketing efforts and brand building, and a lot of new customers or unique customers are coming onto Nykaa platform very clearly. That shows up in unique visitor numbers. But it takes a while for them to keep revisiting, and then it takes a while for us to convert them into transacting customers. Because our model is to engage with the customers on a non-transactional basis, and over time they start transacting also. So it has paid well in past, and we believe that stepping up the funnel to bring a lot more new customers and then over time convert them into buying or transacting customers will work through the content to commerce model that we have built.
Okay. Thanks a lot.
Thank you. The next question is from the line of Amit Sachdeva from HSBC. Please go ahead.
Hi, good evening everyone, and thank you for taking my question. So my first question is on the fashion segment, and if I want to, so a lot of questions have been answered already, so I would not probably go down to that detail again. But my question is, what is the logic of building the fashion business? Is it the marketplace model, which is brings in a lot of third-party brands and build a consumer base, and then eventually the right strategy is to actually build our own brand, which is the anchor is marketplace, but the real value capture lies in, for example, developing 3-4 larger brands which are the own and which allows you higher margin, higher consumer franchise, and also more profitability as well as a result. So in that context, how the inventory model should evolve, because is the own brands right now on inventory or still marketplace like model, and how you are thinking about this as we go forward like 5 years from now, and how the business model will shape as a strategy.
Should I take that?
Yeah, I think you'll have to.
All right. Okay. So, I think in terms of our philosophy, we do really believe in both sides of the business. We do believe in the multi-brand role that we play. There are incredible strong brands in the country and both internationally. And we think that there's a real opportunity to bring all those brands to the country. So that is first and foremost our mission, to be a multi-brand retailer. On the own brand side, as you know, we have about 5 brands today. Across Western wear, Indian wear, jewelry, lingerie, athleisure, and so forth. This is also, a part of the strategy that we feel good and confident about. We found, we felt that there were gaps in the assortment, and we could plug it with our own brand play there. And yes, the margins would be better there. But we first and foremost are committed to the multi-brand side of this business, and so that will always be the dominant share of the business. The own brands that we have, yes, we do hold inventory for that side of the business.
Okay. There is no marketplace-like contract with the suppliers there. You own the inventory there. Just wanted to clarify that.
We own the inventory on the own brand side of the fashion business.
Okay. That's very, very helpful. Thank you so much. Just a small another one. Could you give us a little bit of, because I see that in Q1 we had a disclosure in DRHP for e-retail part of GM and Ebitda margin. Can you share those numbers as well for Q2? The e-retail, like BPC e-retail business, subsidiary, gross margin and Ebitda margin, if you can.
Yeah. So I think clearly it's while each of the subsidiaries are Nykaa e-retail is meant for beauty and personal care business, but also FSN brands does physical retail and some amount of imports business. And then, of course, Nykaa Fashion does the fashion business. And the beauty private label business sits at the top in FSN e-commerce, and this has all been done due to due to FDI rules in India, which are a bit complicated, where the holding company needs to be the manufacturing company and the e-commerce needs to be 100%. I mean, it needs to be not 100%, but needs to be a subsidiary, and things like that, because you cannot have foreign ownership in the e-commerce entity if you want to do inventory led, and you need to be Indian owned and managed at the top. So it's a little bit complicated for us to be able to explain the certain segment numbers of beauty and fashion based on the subsidiary numbers. Mm-hmm. But yeah, they broadly show the trend, and the way the trend is that the beauty business definitely is at a level of maturity where it probably would be at the optimum level of Ebitda. I mean, if it was not COVID times, it is partly a little bit affected by COVID, impact here and there. But beauty business definitely on a omni-channel basis, because second quarter was adverse for physical retail. It was not adverse for e-commerce, but it was adverse for physical retail. And by then, a lot of advantages of rental waivers and all had gone away, and still the many places the stores were not open. So I think it's difficult to generalize, but once COVID is over, I think you can say that the beauty business would be at an optimum level of EBITDA, and fashion would be at a point where we would still be investing and hence having negative EBITDA, but we hope to make that go on a similar path as beauty in a couple of years, 1 or 2 years.
Sure. Well, that's very helpful. The reason I was asking this question was because if I look at last year, and we had the DRHP disclosure only so far on detailed numbers on subsidiary. I saw we had FY21 number of 8% EBITDA margin for e-retail, and at the company level we were at 6.66. And clearly, if I were to analyze in some sense last quarter's A&P spend, like a marketing spend, we are about 40 crores extra in some sense on a run rate basis. And that led to sort of EBITDA margin being 3%. If that was not the case, it would have been 8%. So that's the reason there's a large swing comes in EBITDA margin, and hence some perception issue about how the margin outlook could be. And that's the reason I wanted to understand whether investors should understand economics of two business separately. That would help them understand that one is like in a self-fulfilling mode, the BPC business, and another business in investment mode. But having a blended cost would actually give them more confusion than clarity. If you can separate these two economics well, that would really give a lot of clearer picture for people to appreciate two businesses and the investment cycle correctly. That's the reason I'm asking this.
Yeah, sure. So I think we understand that. We've just finished the IPO and everything. So we were not confident of being able to give all these numbers on a very sustainable basis for last 3 years and all that would be expected of us. But I think we are very aware, and going forward, we'll do the right thing in a couple of quarters and try and do that. But also, please do understand that it was such a COVID-impacted year. Like, we used to have fair amount of business from GTMT for our private label business, but that had also come to a standstill, And we as a company were not cutting costs because we didn't see the point. We had a strong engine in e-commerce, so we did not really sack even our employees who work in our GTMT. So we took a human side of the business, and we decided not to cut any employees. Like, we maintained the salaries and also the employees' jobs through the COVID period, because we realized that it was a huge human price and we could afford it, so to speak. So I think the true picture will start coming as we get out of COVID, which I think has started happening in October. So if we don't have a third wave, which is very adverse, then we'll see that. In fact, second wave, which started in April, May of 2021 in India, was actually very bad from a price, that human price there was to pay. However, surprisingly, because government did not shut the business on an all-India basis, e-commerce business and our business did reasonably okay for that first quarter also. So I think with a better market for e-commerce and improving market for what we call as physical businesses, which are physical retail and also GT/MT businesses which benefit our private labels, I think you'll see a different picture emerge over time.
Got it, ma'am. If I may then squeeze in one small question about the skincare or the cosmetics business. If you could think about as a business as the main driver being e-commerce because of assortment and reach and everything else, could you sort of spell it out a little bit? What is the percentage of revenue of skin and beauty in your business, like cosmetics? And is there a particular, what is the average ticket size you sell for those? And is it how big is the way from the mass, like mass pricing X, you are at 2x or 3x of the mass? What is your fastest growing segment which is fueling this growth? What we want to understand is how tier 2, tier 3 towns are consuming in terms of those skin products. That's where I'm coming from.
I think because the line is a little bit difficult, I'm having trouble understanding your question fully. But if you're asking about average selling price of our products is about 450 or 60 rupees. And while the AOV is at 1850, I think on an average customer buys 4 items in a cart. So typically the average selling price of a product on our site tends to be 450 or 60 rupees. I think makeup and skincare kind of change, the relative importance of makeup and skincare changes slightly here and there, and it could be similar, or sometimes, skincare may go ahead, especially during COVID lockdowns, and there are, festive times or wedding season when, the makeup goes up. Also more because, we are also quite unique in bringing a lot of international brands in each arena. So for us, those are all balanced businesses. I think where we've disclosed in the prospectus that our top 3 categories, which is makeup, skin, and hair, account for 70% of our business.
Got it. Thank you so much, ma'am. All the best. That's very helpful.
Thank you.
Thank you. The next question is from the line of Surya Narayanan Manian from DSP Investment Managers. Please go ahead.
Yeah, hi. Thanks for taking my question. I just wanted to understand the conversion between MAUs, which are your active users, and the transacting users, which is obviously higher for BPC versus fashion. But once fashion, sort of starts to scale up, should that conversion be similar? And the related question to that was, does it have an implication on the unit economics for fashion? Does it require the same level of marketing spend, higher marketing spend, and hence by default does it require a higher AOV versus BPC?
Yeah, so it's a very interesting question, and it's difficult to answer it fully, but I'll try to answer it partially. In terms of yes, our fashion conversions are lower than beauty conversions. And if you look at, we also look at, one is conversion, but the other is also unique conversions. So we also look at unique conversions because we are aware, and you have that data, that our customers visit our website many times within a month itself, and many times in a year for sure. And obviously each of the time they're not buying. So we've always encouraged a user behavior that we like the engagement, that they come often, and maybe some of those times they buy. So that is the story on the beauty side. On fashion also there are similar behavior we are encouraging, where we would like them to come and visit us multiple times and they buy eventually. I think in fashion there are certain barriers that we can breach over time, some being easy returns to size barrier to many other, and also trust that comes with passage of time, and and also word of mouth, as some customers have a very favorable experience, and then they buy more. I think we also cracked like in beauty, one of the main barrier is believing that the product is genuine. So authenticity and genuineness of the product is something we cracked very early on by year 2 and 3 of our business. And I think since then there's been no looking back in terms of having customer trust on quality of our products, and hence the conversions. Conversions, of course, as you may know, vary also between whether they are on our app, whether it's on iOS app, where I think affordability is never an issue. And so iOS app conversion is usually different than Android app conversion, and the mobile web, where a lot of first-time users go there and then over time they download the app. So mobile web conversions are even lower. So the mix of traffic also results in conversion. So long and short is that yes, there's more work to do. We are just happy that we've started getting noticed, and as a result, the unique customer visits on the fashion is very healthy. In fact, Arvind always points out that at 16 million versus 21 million for beauty, it's a very healthy number. Market cap for fashion is also bigger, right? It's 5x. So we really are benefiting from that market cap also in terms of getting customers to come and visit us. And as we offer them meaningful assortment that they get excited about, I think, and also as we learn about their preferences and match the right product to the consumer, the conversions will definitely go up.
Understood. Thanks, sir. Just a quick follow-up there do you need these kind of AOVs to sustain in fashion for you to achieve, whatever is your profitability target?
No, not really. What we thought is that it's better to make the site aspirational and start at the top end. But if you are asking me a question that can the business be sustainable and profitable even at a lower AOV, of course it can.
And I think, just to add to that, it started from the fact that we want to differentiate, and for that differentiation, I think the slightly more premium positioning is what was available in the market. And I think the way I look at it is that if you wanted to go lower in AOV, you could also acquire customers more cheaply. I think it's more expensive to acquire a more premium customer, is the way I look at it.
Understood. All right. Thank you so much.
Thank you. Ladies and gentlemen, due to time constraint, we take that as the last question. I now hand the conference over to Mr. Sanjay Shah for closing comments. Over to you, sir. Mr. Sanjay Shah, over to you, sir, for closing comments.
Oh, thank you so much. Just a quick word of thanks to Falguni, Adwaita, Anchit, Arvind. This was the most insightful conversation and set of commentary. Falguni, as you said, there is so much more to do, and for all that you have achieved, I think it's safe to say that the best is yet to come. So we look forward to more interactions in the future. And with that, I would just like to close this call. To all the investors and people from the sales side who are there on the call, thank you so much for taking the time out, and we shall talk soon. Thank you, everyone.
Thank you.
Thank you. Thank you, everybody, for being with us. Thank you.
Thank you. Ladies and gentlemen, on behalf of Morgan Stanley India Company Private Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.